So most new traders think that trading Forex is all about finding that perfect entry, but that's not actually what blows accounts. It's not the entry, it's the position sizing and the leverage that often blows accounts. And if you don't understand how lots, pips, and leverage work together, then you are gambling, you are not trading. So in this video, I'm going to make this very, very simple for any beginner coming into trading and anyone that has been trading that doesn't quite grasp the concept of these. And by the end of this video, you'll know exactly how much you are risking every single time you hit that buy or sell button. So come with me as I break it all down step by step. So first, let's talk about what is position size. Your position size is simply how big or small your trade is. It's the number of units of a currency that you are buying or selling. So for example, if you're trading Euro USD, your position size will tell you how many euros you're controlling. It's the base currency, and that's normally the first in the two pairs, Euro USD. Euro is the base currency, and that's what you're controlling. And the bigger your position is, the bigger your potential profits, but also the bigger your potential loss. And this is very, very important because a lot of people think that if I'm just controlling a lot more, I can make more. Yes, you can. But remember, you can also lose more. And in most cases, that is what ends up happening, to the point that you actually blow accounts. So now let's move over to talking about how profits and losses are actually calculated. And it's actually very, very simple because it only depends on two things. Number one, how far the price moves, and this is normally calculated in pips, which we're going to talk about. And then secondly, how big your position size is, which is calculated in lots, which we're also going to talk about. So you've got how big your position is and how far price moves. Simple as that. And the formula is even more simple. Your profit or loss is equal to your price movement, measured in pips, multiplied by your position size, measured in lots. Simple as that. Now let's move into talking about exactly what a pip is. Pip stands for percentage in point. It's just the smallest change in price. And for most pairs, this is represented by the fourth decimal place. So for example, if Euro USD were to move from 1.0745 to 1.0746, it has moved 1 pip. Now, there are a few exceptions to this. For example, USD JPY, it's actually the second decimal place. So if USD JPY were to go from 133.88 to 133.89, then that is also 1 pip. Pips simply tell you how far price has moved. Now, I'm going to break this down into an even simpler analogy. I'm going to be using the tomato analogy. Now, imagine you bought yourself tomatoes at 15 cents per tomato, but you then sell them for 20 cents per tomato. That means you're making 5 cents profit for every tomato. Now, if you were to buy 10 tomatoes and then sell those 10 tomatoes for the 5 cents profit per tomato, you'll be looking at 50 cents profit total. Now, how do you make more profit? Simple. You buy more tomatoes in the beginning, so you're holding more tomatoes. Tomatoes is your position size. So if you buy 100 tomatoes at that price and then sell all 100 at that 5 cents profit per tomato, you're now looking at $5 profit instead of just the 50 cents. It's exactly the same profit, but because you held more, you can make more profit. But you also stand to lose more profit, which is very important to remember. Now, it's the same thing in trading. If you make 10 cents per every pip, and let's say the market moves 50 pips, you've now just made $5. The per pip value depends on your lot size, right? So the amount you can make depends on the amount you're holding. It's very, very important, guys. If you ever get confused, just go back to the tomato analogy and that should clear it up for you. Now let's talk about what a lot is. In Forex, trades are measured in lots, which simply represents the number of currency units that you control. And it's broken down into 3 different types of lots. You get the standard lot, which represents 100,000 units of your base currency. And the pip value for this will be $10 for every pip that moves. Then you have the mini lot, which represents 10,000 units of your base currency. And the pip value for this will be $1 per pip, which means every time the market moves 1 pip, you make $1. And then we also have micro lots, which represent 1,000 units of your base currency. And the pip value for this is 10 cents per pip. That means if you are holding a micro lot and the market moves 1 pip, you make 10 cents. So let's say, for example, you are trading one standard lot and the price moves 8 pips. That means 8 pips times the $10, which is the pip value, and that means you make $80 profit for that move. Now, if you were holding a mini lot instead of a standard lot, that would mean that you are now making $8 instead of the $80. And likewise, if you were holding a micro lot, you would only have made 80 cents rather than the $8 for a mini lot or the $80 for a full standard lot. It's the same move, but just the difference is the amount you are holding. So that's how you measure the amount you're holding. You've got standard lot, mini lot, micro lot. Very important to remember this when you're trading. Now, how would this look on a standard trading platform, for example, MT4, MT5? Normally on the top left, you would see that you have the trade size, right? Let's say, for example, it's a 1.23 lot sized trade. To break this down, the 1 would represent your standard lot, the 2 would represent your mini lot, and the 3 would represent your micro lot, right? So this would just mean that your trade is broken down as follows: 1 lot, 2 mini lots, and 3 micro lots, which makes it a 1.23 lot position. Now that we've got all of that, let's talk about leverage, because this is actually what allows most people to trade these lot sizes. Leverage essentially means you are borrowing money from the broker to control larger positions than you would with a smaller deposit. Think of leverage as borrowed buying power. So let's have a look at if you were to join a broker that gives you 30-to-1 leverage. What does this actually mean? It means that for every dollar that you deposit, they will match it with $30. So if you're putting in $10, that means you can actually trade with $300 in the market. If you put down $100, you can actually trade with $3,000. So now, instead of needing that full $100,000 to trade one standard lot on Euro USD, for example, you would only need about $3,333 to trade one full lot, right? Because of that leverage. And it's actually the only reason that a lot of people nowadays can actually trade in the Forex market, because of leverage. But it is also dangerous, because leverage can magnify your profits, but it also means that it can magnify your losses. So it's very important that you use leverage for accessibility, not aggression. So let's look at a quick example of leverage. Let's say your account balance is $1,000, you deposit $1,000, your leverage is 30-to-1, and you open a 0.1 lot, which is a mini lot, which is $1 per pip. If the market were to move 20 pips against you, you would lose $20, which is okay, right? That's 2% of your $1,000 account. Manageable. But let's say with the same size account, you over leverage and you open a full lot. Now all of a sudden, the same 20 pip move is going to cost you $200. This now is 20% of your entire account's balance. Now you've over leveraged, you've risked too much, and this is going to hurt you very, very fast. 5 trades like that, and your account is gone. This is where understanding what leverage you're using, your account size, your lot size, and how to risk accordingly depending on all of this information. So now I'm going to just give you guys a couple final tips, and that is always know your pip value and lot size before opening a trade. Never risk more than 1 to 2% per trade. And then the final one is use leverage responsibly, because it's a tool. It's not a shortcut. Trading is about staying in the game long enough for your edge to play out. And understanding position size is what will keep you there. Now, I hope this made leverage and lot size finally click in some way for you. There's a heck of a lot more information, and you can go a lot more in depth when you are looking at this information. And I'm going to leave a link to a website called Baby Pips, which breaks all of this down for you. So if you want more information, I would highly recommend going to Baby Pips, having a look. They've got brilliant information when it comes to leverage, lot sizing, pips, and all of this information. So if you want to have a look, make sure you go check it out. And if you still find all of this too confusing, but you still want a part of this Forex pie, then look no further than joining us here at Blue Edge Financial, because here at Blue Edge Financial, you don't even have to understand the the Forex market to make money. We have actually got over 1,500 of our members funded with prop firms and making a lot of money just because they are using our incredible system and our incredible EA called Titan X, which trades for you, does everything for you so you don't have to. Now, if you are interested in a system like this, make sure you go to www.propfarming.com. Have a look there. There's an incredible demo video that you can follow. And then if you are interested, make sure you fill in the application form and someone from our team will get back to you. But with that being said, guys, that's the video. I hope you enjoyed it. I hope it helped. Hit that like button if you did like it, and make sure you subbed up for more videos like this. With that being said, guys, we'll see you in the next video. Bye for now.